Hey everyone, Coach Investor here with the first video of 2023. First of all, Happy New Year to everyone. I hope you're not all hungover. Hope you had a great time with your friends and family. So let's try and make 2023 an unforgettable year, but not an unforgettable like 2022. Let's make the best of it. Let's try and learn and grow as investors. As always, I would really appreciate it if you hit that thumbs up button and subscribe if you have not. Let's try and build up this community some more. Now, first of all, I do have to announce some winners from a contest we ran earlier last year. So on stockcard.io, you could have entered this contest for free. You can still follow this channel's portfolio completely free. You just have to create an account and that's about it. Now the winners here. So the winner for the $250 cash prize is Beat Lazy Investing, outperformed 36.70%. And then the top 5 winners will get 3 months Stockcard VIP access. So congrats to Blastoise, PsychoBunny, Can I Win Too, Ruffle My Waffle, and of course, Beat Lazy Investing. Again, congrats to everybody that, had participated and was a bit greenish. Not that many people, but still, if you want to follow this channel's portfolio, see how we do, see why we do it, it's free. Link is down in the description, and maybe we'll run another competition in 2023. And so in this video, I'll talk about the 3 stocks I've added to my portfolio. Most of them are down. Most of them have been covered on this channel. And maybe some of them might be going a bit lower as well. I don't know. I'm not here to time the market. I'm here to be a long time in the market. And I'm also going to talk about 2 companies that I did sell. One company is Teladoc. I sold because, first of all, my position was just 1% of my portfolio. I thought, hey, what the heck, right now it doesn't really make any sense to hold it again. There are other opportunities out there. And the money obviously went to one of the 3 companies we're going to go over later in this video. Then the other company I sold was Nanox, also a 1% of the portfolio, which was a bet to start with. Never really talked about it on this channel because, again, it was a bet. At the moment, again, I could use that cash, put it in other positions as well. And then actually, third company I recently sold is Shopify. I'll explain later in this video. All right, so first company I've added in my portfolio, maybe it might surprise some of you, maybe not, but it is actually Airbnb. Of course, Airbnb's card right now, if you look at it, lots of red. But most of the red things here are actually good buying wise. Technicals, bearish or oversold, yes, okay, fine by me. Other performing peers returns, fine by me as well. It's just a bearish market right now. Nothing you can do. Overvalue stock, of course, it is trading at around 30 times forward PE, so it's not that cheap. But for a company that is free cash flow positive and growing over $3 billion in the last 12 months in free cash flow, going into 2023, I think it's a pretty good company to hold. Now, the stock in the last 3 months is down 20%. In the last year, it's down 50%. Analysts see a 45% upside in the next 6 to 12 months. Fine by me. I don't really care about 6 to 12 months. I plan on holding Airbnb for a long, long time. So one of the companies I bought with the cash I raised is obviously Airbnb, added to my position. Now, I do want to mention some extra stats here to maybe fortify or make sense of why I added to Airbnb, not other positions. So first, a couple of things that were mentioned last quarter with regards to the quarter we're in right now, or we were just in. So 4 weeks into this quarter, so Q4, we're seeing really strong promising trends in cross-border, renewed interest in urban stays, stabilizing cancellations, and just strong future bookings. Our guidance for Q4, we're anticipating revenue growth between 17 and 23%, and that's 23 to 29% excluding the impacts of foreign exchange. Now remember what I keep saying, the dollar is weakening compared to Q3, so that might be a tailwind for some companies. And of course, for a company like Airbnb with travel, when the dollar was strong, you probably had lots of US travelers go to Asia, go to Europe because their currency is strong. Maybe less Europeans wanted to go to the United States because their currency was a bit weaker. Now that that is changing a little bit, maybe that might restart and boost a bit of the US travel from foreigners. But anyways, lots of travel in Europe, lots of travel in Asia, and lots of travel in the United States. as we can see some key November highlights right here. So travel spending moderated a bit in October after reaching a pandemic high in September, but still remains positive at 3% above 2019 levels. Strong headwinds continue to prevent international inbound travel recovery. Overseas arrival remained 30% below 2019 levels in October, probably because of the currency, because of high inflation, the current macroeconomic environment. Logical numbers there. Despite increasing airfares, air passenger volume continues to steadily improve, maybe not for Southwest, and was 5% below 2019 levels in October. Nearly 8 in 10 current business travelers expect to attend a conference, convention, or trade show in the next 6 months, similar but slightly down from Q2 2022. And lasting here, just over half of American travelers believe they will make leisure travel a high spending priority in the next 3 months, a 10-month low. A 10-month low, but still pretty positive in my eyes. And lasting here, we can see here the headline, travel abroad is poised for a big comeback in 2023 as Americans eye trips to Asia and Europe. So the key points here, 31% of Americans are more interested in international than domestic travel. Households are continuing to unleash 2 or 3 years worth of pent-up demand as COVID-19 fears wane and the last vestiges of pandemic-era border restrictions have eased. Of course, now with China reopening, etc., we might even see a bigger effect. And then lasting here, Asia Pacific is drawing particular vigorous interest, although European destinations retain their popularity too. I've recently been in Japan, and probably Japan is going to be an extremely popular destination in 2023. Airbnb has a presence in Japan as well, might boost the business for sure. And then stock number 2 is obviously a no-brainer, but before I go into that, if you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to flow.com/couchinvestor and make sure to check out all the other links in the pinned comment. I would really appreciate that. So stock number 2 is obviously my biggest position and a no-brainer for me. I've never been this bullish on the company, especially since the stock is down quite a lot, especially in the last 3 months. It's down 55%. And if you're listening and not watching, it's Tesla. Tesla to me right now is in the same position stock-wise as in 2019, where it was peak fear. I've tweeted about it on Twitter. Today, the company itself is in a much better position than in 2019, but stock-wise, we're not really that far apart. Obviously, the card here is a bit more positive than the one for Airbnb, but overall, even with peak, let's say, bearishness or negative sentiment towards the company, I know it says here that the average analyst target or upside sees 141.5%. I believe it's a bit lower than that, but still 3 digits with all of the bearish negative sentiment right now around Tesla, pretty good. Again, if you look at the chart for the full year, so let's look at 1 year, you can see that from the start of the year until September, end of September, yes, the stock was down, but the stock was performing much better than the broader tech market and maybe even in line with the general market. It's only since that Twitter deal has gone through that the stock goes down 60%. Of course, Elon selling doesn't help, but the business itself, the fundamentals, are just getting better and better. Next week, probably on Monday night, we're going to get the production and delivery numbers. At the end of January, we're going to have, obviously, the earnings report. And the tone will change quite quickly when suddenly the market will wake up and see, Tesla might be a bit undervalued here, close to 21 times forward PE, growing so fast, printing so much cash, while its competitors are bleeding cash and losing money on every vehicle they sell. And since we're all thinking the same thing, we're going to a recession, would you like to own a company that, prints money, billions of it every quarter? Or would you like to own a company that is losing money on every car they own, while they still have to make ICE vehicles, while they still have to ramp up their EV department? I mean, it's pretty easy to choose, right? And so that's why I've added more shares to my position for Tesla. It's still my number 1 position, of course, being down over 60% in just 1 year sucks. I'm in Tesla already since 2019. I'm sure some of my viewers are in it even before that. Again, if you just look at it in a short-term period, of course it hurts, but it doesn't make any sense. You shouldn't buy Tesla for 1 year or 2 years. And like Elon said, if you can't handle the volatility, just don't own it. There are other companies out there, like my number 3 pick right here, which is Amazon, which by the way is also down quite a lot. As you can see here, in the last year, it's down 50%. A huge company like Amazon can be down 50%. Yes, all companies can go down 50%. As we've seen in the last 2 years, nobody is safe. Now, with Amazon, I have to go back to my point to why I sold Shopify. I sold Shopify because if you look at the current prices for Shopify and for Amazon, and that's just for my case specifically because Amazon is already my second largest position. Shopify, not really in my top 5, although I still regard the company very, very high. Still going to be a great company, but still being down, I think Shopify is down over 75% or so just this year, and still being so expensive. To be honest, going into 2023, a recession, still high inflation, we don't know what's going to happen exactly. I feel it's maybe a safer and a better bet for the long term as well to just increase my position in Amazon. And so I did. I sold Shopify, took all that cash and poured it into Amazon. Amazon has now become even a larger second position in my portfolio. Why? I've talked about Amazon a ton of times on this channel. I think the advertising business is growing extremely fast and nobody really paying attention to it. It's a high margin business as well, high margin segment of the Amazon business. AWS, same story there. To be honest, right now at Amazon is around $834 billion in market cap. If you give AWS and the advertising segment a semi-high multiple, I think just those two segments of the business could be worth as much as $800 billion. Of course, not with a 10 times forward PE or something like that, towards the 2025 or so, for sure. And then you have all the rest, the subscription, the online shops, the third-party seller services. I mean, Amazon is a tremendous business. Prime, Amazon Prime, the members there, the added value, the value that you get from just paying, really depends where you are at, but let's say $100, $120 or so per year, you get a ton of value. And it won't be surprising if they keep raising that price because the value that you get from it is just, it's worth it. It's honestly worth it. And just for the sake of this video, obviously, let's just look again at the analyst price target. The average one, they see a 97% upside in the next 6 to 12 months. Again, analyst price targets might change very, very quickly, go from a very bearish sentiment environment to a very bullish one. But just for the sake of this video, this is the target, 97% upside. I don't really care what happens in the 6 to 12 months when it comes to Amazon, Tesla, or Airbnb, or any other holding I have. So for the long term, I plan on keeping those positions for a very, very long time. And as I said with the, let's say, Google video not so long ago, yes, in the future, huge companies that are printing a lot of cash, I know Amazon right now is free cash flow negative, but with all the cost cuts, with the faster growing size of the business with higher margins, I do think that in a decade or more, they might probably be paying me a dividend or just be buying more and more shares. Tesla, I do expect 2023 to have a buyback program announced. Airbnb, already buying back shares, not that much, but hey, free cash flow positive, so put that money to work, right? So these are the 3 stocks that I bought, 3 stocks that I sold, starting 2023 in a good mood. Obviously, do share your thoughts down in the comments below. Have you been changing your portfolio? Let me know down in the comments below. And don't forget to write your predictions for 2023 in the dedicated community post. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I see you all in the next one. Bye-bye.